Hey there and welcome to our channel. In today's video, we'll be discussing decoding the 2008 financial crisis, uncovering the aftermath 15 years later and exploring the lasting impact on the global economy. We're excited to share our thoughts and insights with you, so let's get started. Hello and welcome to our in-depth video on the 2007-2008 financial crisis. This crisis, which began in the summer of 2007, was a result of years of cheap credit and lax lending standards that fueled a housing bubble. Despite warning signs such as the collapse of two Bear Stearns hedge funds and warnings from BNP Paribas that investors might not be able to withdraw money from three of its funds, few investors suspected that the worst crisis in nearly 8 decades was about to engulf the global financial system, bringing Wall Street's giants to their knees and triggering the Great Recession. To understand the 2008 financial crisis, it's important to understand the context in which it occurred. The dot-com bubble had burst, and the September 11 terrorist attacks had occurred. In response, the Federal Reserve lowered interest rates in an attempt to boost the economy and make money more readily available to businesses and consumers. This led to an upward spiral in home prices and increased risk-taking among banks. Additionally, the Securities and Exchange Commission, SEC, relaxed net capital requirements for investment banks, freeing them to leverage their initial investments by up to 30 or even 40 times. By 2004, U.S. homeownership had peaked at 69.2%. However, as interest rates began to rise and homeownership reached a saturation point, home prices began to fall in early 2006. This caused real hardship for many Americans, as their homes were worth less than they paid for them and they couldn't sell their houses without owing money to the banks. They found themselves trapped in homes they couldn't afford. As the crisis developed, subprime lenders began to file for bankruptcy in early 2007. In June 2007, two big hedge funds failed, weighed down by investments in subprime loans. By August 2007, losses from subprime loan investments caused a panic that froze the global lending system. The crisis reached its climax in September 2008, when Lehman Brothers, a large investment bank, filed for bankruptcy, triggering a panic that froze the global lending system. The bankruptcy of Lehman Brothers was the largest in U.S. history, and it caused a domino effect that led to the failure of many other financial institutions. The 2008 financial crisis affected people all over the world, and it resulted in the loss of many jobs, savings, and homes. It also led to a deep recession that lasted for several years. The crisis also brought to light the need for stricter regulation of financial institutions to prevent such a crisis from happening again in the future. Now, 15 years on from the financial crisis, it's important to ask ourselves, are the effects still being felt? The answer is yes, in various aspects of our economy and society. The lingering impact on the housing market, the job market, and the banking industry, as well as public trust in government and financial institutions, are among the most significant effects. In the housing market, home prices have risen in many areas, but they have not returned to pre-crisis levels in many regions, making it difficult for many people to afford to buy a home and contributing to the ongoing affordability crisis. In the job market, the unemployment rate is still higher than it was before the crisis, and many workers are still struggling to find good-paying jobs. This has had a significant impact on people's ability to save for retirement and has contributed to the ongoing problem of income inequality. The financial crisis also had a major impact on the banking industry. The collapse of many financial institutions led to a crisis of confidence in the banking system, and it took many years for the industry to fully recover. The industry is now more heavily regulated than it was before the crisis, but it has also made it more difficult for small businesses and entrepreneurs to get access to credit. The crisis also had a major impact on public trust in government and financial institutions. The crisis exposed many shortcomings in the regulatory system and the way financial institutions were run, leading to a loss of trust in government and financial institutions. This has made it more difficult for governments and financial institutions to effectively respond to future crises. In conclusion, 15 years on from the 2008 financial crisis, the effects of the crisis can still be felt in various aspects of our economy and society. The lingering impact on the housing market, the job market, the banking industry, and public trust in government and financial institutions are among the most significant effects. While steps have been taken to prevent another crisis and mitigate its effects, it is clear that the 2008 financial crisis had a profound and long-lasting impact on our economy and society. It is important to remember the lessons learned from this crisis and continue to strive for a more stable and equitable financial system for all. We hope you have a better understanding of the ongoing effects of the 2008 financial crisis. Thanks for watching our video. We hope you enjoyed it and learned something new. If you liked it, please give it a thumbs up and consider subscribing to our channel for more content like this. Don't forget to leave a comment and let us know what you thought. Until next time, take care.